Many ICT traders or SMC traders are destined to fail before they even get started. And the reason for this is overcomplication. 90% of the time, these price models, entry models, bias, or narrative tools are blown way out of proportion. I've been trading for years, and I'm a funded trader with my Forex funds. And one thing I can tell you is that you have to simplify your strategies or they're going to be completely useless. While it's great to be precise and to incorporate time and other complicated factors into your trading, it will only hurt you if you're not able to simplify and translate that into an executable strategy. Too often do I see people just drawing boxes on charts, trying to sound smarter than this guy or this guy. So what I want to go over today is one of the most overcomplicated ICT models out there, which is market maker models. I'm going to show you exactly how to spot them and how to actually use them. So let's go ahead and get into it. All right, so today we're going to be going over market maker models. So market maker models are an ICT concept. I did not discover or come up with it, but I think that it's sometimes hard to find a good teaching of them. A lot of people know what they are. They have the ICT slideshow picture in their head with red and blue boxes and a squiggly line, but that doesn't really help you whenever you're trying to execute. And I know that I've got a lot of questions on it, and I also know that I had a difficult learning process when it came to this model. And it's crazy because it's not complicated. It is not a complicated thing. So I want you to, before we start, I just want you to, if you have any kind of perception that this is a super complicated or hard to learn model, I want you to kind of try to approach this class with an open mind, because my goal here is to show you what's important and help you realize that it's not all that complicated. But market maker models are an ICT trade setup that occurs as price trades into a higher time frame liquidity pool. So the idea of a market maker model, we have our original consolidation, our expansion, and our second consolidation. Now, our run into our liquidity pool. So whenever we're talking about the liquidity pool that the narrative is built around, what we're building this trade idea off of, we're talking about this one right here, where the third segment of our model occurs. And oftentimes you're going to realize as you watch this or as you review it that you've probably been trading these models. If you are trading based off of pretty much anything that I go over in the stream, there's probably been a time where without knowing it, you've traded a market maker model. And it's just a narrative. All it is kind of explaining what's going on, so that way you have a deeper understanding of your trade setup, and inherently that will boost your confidence if you understand what's going on and why it's happening. So here we have our higher time frame liquidity pool that the model is based around, and we get our reversal here. This is what we call a smart money reversal. So we then have our second little consolidation and another massive displacement. Distribution, there's a lot of different words we're gonna go over and explain it in depth. I don't want to confuse everybody with a bunch of big words like smart money loves to do. During both of these areas right here, we have a breakup structure with displacement, and we have another breakup structure with displacement. Now there are two entries, one here, where that's the model we use often, where we just get that market structure shift, return to a price delivery array, or whatever your entry model is, and there's numerous that you can use, but this is the narrative. We get that shift, so that's our smart money reversal. And then we have our second leg of distribution, and price then usually expands quite rapidly into our target, which is the opposing liquidity in the initial consolidation. Now, you can have targets lower, and this is where bias comes into play. But the model itself is this initial consolidation. Then we have our second range, where we're running up to this, quote, support or resistance, which is our liquidity pool we're framing the trade around. Our smart money reversal, our second distribution, and then we have usually a consolidation down here. As with anything, there is theory and there's reality. So not everything is going to look this picture perfect. And my goal is to explain every bit of this so that you're able to use it because you understand it, not because it looks exactly how the drawing board showed you. That's if you've been trading SMC for any kind of extended period of time, you know that the infographics, the purpose of them is not to show you a visual of how it's going to look every single time, but rather to explain what is going on. So that way you can take that understanding and that knowledge and then apply it to a live market, which is always going to be different. Most valuable as a narrative tool. A crash course in the difference is a narrative of what price is doing and why it's doing that. And then an execution model or tool is how we capitalize off that. So for instance, this entire model would be the narrative and this break of structure here. And if we decided we wanted to enter based off of that, that would be our execution. So again, it's most valuable as a narrative tool, but it does provide two specific entries, and that's going to be on the second leg of distribution after that displacement and on the first reversal. Now, what this is considered up here is low risk entry, and this is high probability. So, let's say we have a fair value gap here after that second leg of distribution, just like we had the fair value gap in our first reversal. Those are both entry points. And once you understand what price is doing and you understand what part of the curve, so to speak. So for instance, on the way up, price was seeking the buy side because our narrative was we were pushing into this buy side liquidity pool. So the price was on this side of the curve seeking the buy side. And then once we reach our target and we reverse, then we are now reaching the sell side. So understanding the narrative and understanding if we are in a quote buy or sell program is invaluable, because once you understand where price is going and why it's going there, you then can take that knowledge and take your knowledge of how to execute and combine them. And that is how you get a high probability trade setup. Bias is very important when we're building the narrative of why this model is even occurring, because it's very easy once you learn this to go want to use it and you'll force it and you'll say this is happening now, or this is a market maker sell or market maker buy. But you have to ask yourself, why is it happening? So for instance, if maybe this was an old high on the daily and the overall bias is bearish, that would then complement this to be more likely. Another very important thing I want to go over is how important it is to use a liquidity pool on a higher time frame than the prospective time frame. So for instance, if what we're seeing here, all this price action is on a 1 hour, you would want this high to be found on a daily. Or if all of this is something we're viewing on a 1 minute, you would want this high to be formed on a 1 hour or a 15 minute. It just needs to be a higher time frame relative to what you're using to kind of view the occurrence. Now, higher time frame doesn't mean we're on a 1 minute and we're using a 3 minute high. It means a different ballpark. So for instance, we have our weekly and our monthly, and then we have our daily, and then we kind of go down into a 4 hour, a 1 hour, 5 minute, 1 minute. And that's not the only time frames you can use. Don't be too black and white. There's gray areas that some people use a 15 minute rather than 1 hour. But the gist of what I'm trying to get across is you need to use different perspectives, because if you're looking at a 1 minute and trying to draw out this market maker model, it's going to be very low probability if you're trying to also pair it with 1 minute liquidity. You need to be pairing it with a higher time frame. So the key takeaway here of what's actually going on, and I'm not talking about Wyckoff, I'm just using the terms, right? Because the terms are words other than Wyckoff or other than ICT or smart money concepts. But we have our consolidation, which is the initial consolidation. This forms liquidity. We have our accumulation or distribution of orders, basically a second range. The important part is it's a second range before we get to our target. So it's engineering more liquidity. So there's going to be people putting stop losses here and here. And then there's also people trading the breakouts. So if people are trading the breakouts here, they're going to put their stop loss under the lows. If they're trading the breakout here, they're going to put their stop loss under the lows. So it's engineering liquidity. And now another thing that I want to go over before I explain all this, just the next bullet point, is market maker models depict the process of order pairing, which is what all smart money concepts is about, but few people take the time to really understand what that means. So order pairing, as in if smart money looks to go short, which means, again, it goes back to bias. If we're in a bearish bias on the daily, then smart money wants to go short. Where are they going to go short? Above an old high, because there's a liquidity that allows them to do so. We use that smart money reversal to confirm they're selling to the buyers above that old high, whether those buyers are the form of shorts getting stopped out or breakout buyers. And in order to offload their positions, they're creating liquidity under these ranges. Now, again, and I said we could have another higher time frame level that might be the main target. Again, that's why bias is important. But if I am looking to go short, I'm going to need to be able to enter, which is going to be our buy side liquidity here. And if I want to offload my position and profit off of it, I have to exit. So who am I going to sell it to, so to speak? Whose stops am I going to buy if I'm in a short? It's going to be these stops, and then whatever other higher time frame targets. So we have a consolidation, another second range before we hit our target. Our smart money reversal. This is where we get our low risk sell or low risk buy. Now, again, I'm just using short examples because that's the flavor of the market right now. Well, it might not be for much longer. We'll see. And it hasn't been recently. I think everybody's used to being bearish. So I'm just using a bearish example. This can be used in either way. Just like anything I teach you, it has an inverse. We're in a numbers game here. We can still, this can be a market maker buy. If I just flip it upside down, everything is the same. But we have our smart money reversal that is confirming the smart money is entering the marketplace, utilizing the liquidity that we've based this entire model over. And that's how we determine we're on the opposite end of the curve. And now the market went from a buy program because price was being manipulated. Because if we're in a bearish bias and price is being manipulated to the upside, the market makers, hence the market maker name, are now engineering a narrative to where there's going to be stops here, there's going to be stops here, so they can offload that position. And once we're on that sell side of the curve, then we're seeking out these stops. And it's just a way to visualize it and a way to understand what's going on. There are two entries to the market maker model. There's a low risk and a high probability. And we're going to go over examples of all this. I'm not going to just give you guys lines. The low risk is the first entry, which the reason it's called low risk is because your stop. If you're wrong, then the trade idea was completely wrong. Like for instance, if you get stopped out and you waited for the displacement, then the market's probably going to go higher. So it's low risk in terms of you're getting in near the invalidation point. If you get stopped, most likely the whole idea was wrong. Now, the high probability entry is after the second leg of distribution or inside this range. And this is an area I think that people disagree on sometimes, and I'll give you my perspective of it and how I use it. But this is the harder entry. It's called high probability. I didn't make that up. And I think the reason it's kind of high probability is because it is once you have confirmed that you are in a sell program. But it's very easy to fumble and get stopped out, and then the trades still go in your direction trying to utilize this entry model. I personally like the low risk models, but I will not shy away from taking a high probability model either. Usually the only reason I take them is if I missed this entry. So this is a great way to follow your narrative and not just become a missor whenever the trade doesn't give you your first entry. If you truly develop an understanding of what is going on in the process of order pairing and what side of the curve and what liquidity is the market seeking, then you just have to know where to get in. Once you know which way the river's flowing, this game becomes much, much easier and the opportunities grow very quickly. So for targets, they can be found in the higher time frame, which maybe this was an old fair value gap under the model on a daily, or an old low on the daily, or equal lows, or an order block, whatever. Or you can use the liquidity created by the initial consolidation, which is right here. Or maybe you target an imbalance that was right here, or you could use liquidity under this. And this is all really a personal preference thing. If you're correct, it should take this low, though. This should be like a final TP. Anything extended might be a little bit more risky, I guess, so to speak, that the market might, come down here and come back up and take out that level, because the process of order pairing always is occurring. And at some point, the liquidity formed here will probably be taken. So you don't get in like a tunnel vision mindset where you just think we're on the sell side, because again, this will then occur and we'll start to move up. And maybe that happens here, maybe that happens there. Now that is for you to judge, and you have to develop a system where you consistently choose one or the other if you decide to use this in your trading plan. So this is the price of crude oil. We got 4 hours, sorry. So we have our overall daily bias is bearish. Why? Well, because the market is showing a displacement on the downside. We have a bearish impulse swing right here that we're operating within. Price traded into a higher time frame order block and failed to break structure. So we know that this high is going to get taken. So that's where our narrative, our bias came from. His bias is bearish, that we're going to seek these lows out because it is the external liquidity. We know that price moves from external liquidity, which we did here, back to internal liquidity, which we did. And then price will eventually seek out these lows. Now, in this example, it was a little more complex. We didn't get a straight push down into the sell side. We had a consolidation. Now, what was that consolidation? That was a market maker sell model. So we had an original consolidation, and we're basing this off a bearish daily bias due to this range. We have our liquidity pool right here, which is that daily old high. Consolidation here. We get our second run up. Smart money reversal above that daily high. Agreement with our bias. Push down. Where did price go to? Fair value gap. So that was your first idea. That was your execution. Now look at this. Price moves down. Break a structure. Massive fair value gap. Or you could have said order block. Again, it's all what you want to use. I'm just using fair value gaps to keep the examples consistent. But you could have said, okay, well, I'm trading off this order block. That would have been a better entry. But nonetheless, that's high probability sell into the sell side liquidity, the range. Now, this is an example of using a higher time frame target, and the correct way to do it. Something else I want to show you guys. Right, with that 100% extension. So you could have had more confidence, so to speak, in this, because you know it's very close to an extension of the original range. Because remember, we're working, trying to identify algorithmic footprints. And algorithms love numbers, obviously. So we're going to see systemic and consistent expansions of ranges, measured moves, if you will. So we then have a push up above that, and we have, or sorry, I kind of lost train of thought. Now, if we're talking about targeting a higher time frame level beyond the model, because remember, the model, so to speak, is right here. That's your target. But if we're operating within that daily bias, we're targeting this, because again, this daily range price has moved up, swept out internal liquidity, traded into this. Actually, it didn't trade into that. Sorry, in the daily, it traded into a order block was what it was. Traded into this daily order block. And we know that we've moved into a premium. We've swept out all liquidity. We have no reason to go anywhere but here. So that would be an example of properly using the higher time frames to target. So hope this helped you guys. And you can see that it isn't as complicated as it may seem. I mean, I'm not saying it's something you're going to get immediately, but the idea used with proper execution can give you a high conviction on your trades that you're not going to get scared and sell or take profits early. So in conclusion, main takeaways I want you to have, and watch this again. If you actually give a shit, watch this twice. Don't just watch this and then you'll try to trade a market maker model tomorrow morning. So main points, market maker models visualize the process of institutional order pairing. Hence their name. Right? We're just trying to visualize an occurrence in the market. So not all models will be picture perfect. It's important that you just understand what's going on. It's not going to be that same perfect infographic that you learned from on Twitter. It's not going to be that. So stop looking for that. Look for a narrative that you have a genuine understanding of why it's happening. So again, I like using market maker models as a narrative tool, and they do have 2 entry models, but I think the highest value source you're going to get is using them to build a confident narrative of what's going on. But you can use this narrative to develop your own strategies. You don't have to use those 2 entry models. Again, once we have a narrative, we know which way the river is flowing. We just look for an entry. That's it. So last but not least, liquidity pools that the model is framed around should be found on the higher time frame. Now, again, what does HTF mean? Does that mean 1 hour or a daily or a monthly? No, it just means higher than the time frame that you are looking at the model on. So if you're trying to find a 1 minute market maker sell model, look at 1 hour liquidity. If you're trying to use a 1 hour model, look at daily liquidity. If you're trying to use a 4 hour liquidity pool, look at it on a 15 minute. You just need to be using a layered analysis. But the liquidity pool should be found on a higher time frame than the model is being viewed on. Thanks for making it to the end of the video. If you want access to the private Discord, use code CASPER, all caps, to start your free trial. That's where I provide my trade signals, teach my private classes, and you have access to one of the best trading communities out there. I really appreciate you guys taking the time to watch my content, and if you ever have any questions, feel free to hit me up on any of my social medias. They are all down in the description with the link to Playbit. Have a great day, and remember, if you can't see the liquidity, then you are the liquidity.